Okay. Well, let's welcome in Venugopal Garre. He's Managing Director, India Head of Research at Bernstein. And Venu, welcome back. It's been a while. Venu, by the way, I must say, was one of the first to write about the slowdown. In that report, which I think came out in September, that things are slowing and markets are not paying attention, and they will eventually pay attention. They are paying attention now, Venu, front and square. But I will get to the market, etc., in just a bit as we go along. But I want to start by asking you, Samir Arora, an investor, quoted a Bernstein report I was reading. I read this tweet. I didn't read the report. I don't know if you saw it. He was talking about the solar opportunity, solar capacity here, solar capacity in the US, and what the solar sort of stocks trade at in terms of market value and what they trade at here. So I just wanted to begin there, Venu. Just that report on what are you guys really saying?
No, so actually that's a very different reference point per se. I guess the fundamental reality of what we are talking about eventually veers down to valuations. So if you were to look at specific companies on the solar manufacturing side in terms of where they are valued relative to potential manufacturing capacities of theirs compared to companies listed in the US with capacities, let's say similar, if you were to make it like to like, there was a significant overvaluation for those particular entities, right? So it was a very specific case, not really talking about solar market in general, but we're really pointing out to overvaluation in some of these sort of future growth areas at this juncture.
So what are those numbers for our viewers, Venu? I mean, so for our viewers, what matters is solar stocks, not solar market. And so your point is absolutely...
let me put it this way in a very simplistic way, since I don't want to get to a specific stock. Even if those stocks were to trade at 20% or 25% of where they are in terms of market caps, they would still be above fair value.
Oh, wow. And this is, of course, I mean, assuming, sort of a lot of growth and a lot of capacity addition, etc. But that is true both for US and India as well. That's the point you're making.
No, exactly. So I think the overvaluation is not there. The overvaluation is here, right? So that's like the fundamental difference. I think what has basically happened out here is that whenever any new theme or opportunity comes up, you tend to believe that opportunity will play out in a much, much significant way in terms of scale. And number two, most people believe that it is not just an India opportunity, but also an export opportunity. And then you sort of extrapolate that into the future. So that's where potentially where we were in specific cases and specific instances. I wouldn't really call it as a call in the market per se, but this just tells you the euphoria that has in general percolated into anything where you potentially see a theme.
Venugopal, hi, good morning. I have to ask you this because it's the news of the morning, right? What we've woken up to in terms of charges, indictment, SEC notifications on a large conglomerate here in India, the Adani Group, right? Now, the last time this happened, there was another report from Hindenburg. The market didn't take any notice because it was a research firm writing something. But this time, it is authorities and courts, though of a different country. The stocks are down. But I mean, I don't know if you have coverage in the group. Tell us if you do at all. And whether you think this will become a bit of a stock market issue. It did at the first point in time. I mean, when the matter first broke out 2 years ago. But how do you view the overnight developments and the implications for the market as a whole?
No, it's a fair point. I guess it's a topical question. In reality, it just happened overnight. Broadly, I'll give you a top-down representation of how we see from a market point of view, because I don't want to specifically talk about this group for various reasons. See, the approach to us primarily is that some of these incidents that we typically see are not just an India-specific incident. We have seen such cases globally as well on various MNCs over time, and it's very well documented over time, over the last 5 years, 10 years, and 15 years. Not just about market impact, we've essentially not even seen impact on those individual companies in terms of stock prices. Investors who focus a lot on those areas eventually ended up investing in those companies. So what I'm basically trying to hint at is anything of this nature tends to be very short-term, episodic. Cases keep happening. Anything linked to infrastructure and government, it's a global challenge in general. So one has to live with it, and those who invest in this really know the reality of it. So in Markets perspective, I think markets will forget it in a day, maximum in a week, and then life goes on. That's the way we would approach it per se. So I won't read too much into what is happening at this juncture. It is sub judice. A lot of things will play out. Eventually, we don't know what conclusions will come through. But I'm not really anchoring my market view based on incidents like this, because I've seen this happening globally over and over again. And some of the highest quality investors I've seen getting into those companies. I'm not talking about Indian names, even MNC names.
Hi, Venu. Good morning and good to see you. And as always, you're mentioning in your note, you're expecting a limited moderation in Nifty, a further but limited moderation in Nifty from current levels of around this 23,500. We've corrected close to 10% from the peak. Give and take everything. The earnings season has been very, very disappointing. The government is trying to do their bit now and pep up some kind of that capex spend. What's the downside first, to our current levels?
Yeah, so you're right. I have broadly been of the view that this year should end with high single-digit growth or returns for Nifty. And my viewpoint was that, look, this is slightly above FD rate, if at all. And what we see from a market standpoint, Nifty is closer to my year-end target of 23,500. I didn't really get swayed too much on changing my target. This 23,500 target, by the way, was also based on higher liquidity remaining in the market. So to put it in construct, this implies 13 to 13.5% free cash growth for Nifty 50 stocks over the next 15 years. Now, that's not really an easy thing to achieve. So there was an element of cyclicality. There was an element of slight overvaluation that I had built in my model when I arrived at this target. So what I mean to say by this is that it is not that we are cheap from a market standpoint just because of the 10% correction of an overvalued market when it was 26,000. Going forward, however, the way I approach it is that this earnings weakness that I've been talking about, not just in September, since May, has been driven by a lot of factors, which is linked to capex evaluation, linked to consumption challenges in the economy, linked to margin fatigue that we were actually seeing across the board. So all that put together meant that whatever we were building for earnings, which is consensus, did not have room for upgrades. If at all, it had room for downgrades. First half, we essentially ended up seeing probably flat to marginal growth from a earnings standpoint. And second half, there's an expectation of 20% growth. I don't think that's going to play out. You will see some degree of potential earnings cut. Now, if you assume domestic liquidity remains and FIIs don't really exit significantly much more from here, and retail flows sustain at the levels that we have seen, I wouldn't really see the downside as much more than 5%. So it doesn't mean market becomes cheap. It's an overvalued market still, but the downside is not much. Very quick thing I want to highlight is that we are still early cycle as a country. There is still room for government to spruce up capex. It's not going to happen in 3 months, but probably over the next year. There is still room for rates to get cut over time. So it's not like liquidity is too rampant at this juncture. So there are a lot of these things which can eventually sort of support the market. When I say market, is the economy on a 12 to 18 month view.
Venu, you run a the India portfolio, right? And there are some small cap stocks also, which you I think added about a year ago, maybe a little more.
Yeah.
So for viewers, from a published perspective, 2 or 3 ideas which have fallen enough or which you still think are going to come out winners out of all of this?
Look, firstly, nothing has fallen enough. Okay, so I wouldn't really say that anything has materially corrected enough to say that it's value at this juncture. In fact, the most interesting thing is my SMID portfolio.
From your published list, maybe nothing has fallen enough. I can assure you lots of stuff has fallen 30, 40, 50%.
So,
but we're talking about what you publish. Go on.
Yeah, so you mentioned about SMID portfolio. My SMID portfolio has stocks like Dixon Technologies and Keynes Tech and Muthoot Finance. Right?
Yeah.
They've not fallen at all. I mean, you can call it probably the art of selection, but these were really high valuation, high growth stocks. So I can't even say they've corrected off the peak. They're at the peak at this juncture. So I used to have a stock called Delivery earlier. I actually took profit at 450. So it's no longer a part of the portfolio. That's fallen to 330, 340. We're still not getting back in. But the reality is, on my SMID portfolio, there is nothing at this juncture. which I would probably say.
You seem like you're complaining, Venu. Don't complain. You should actually.
No, not at all.
Send it
I
to
don't
your
want them to fall.
Send your clients. Well, this is what I said.
The art
In
of...
my large cap portfolio, I would probably say that, look, let me say large cap portfolio or sectoral perspective, I think there is too much of negativity on frontline retail, for example. Don't want to mention names out there, but the reality is some of these physical retail stocks, have corrected quite a bit off the peak. Maybe those are the ones one could still look at, not right from bottom fishing perspective, but they are stocks which still have enough growth runway over the next 5-10 years. If we were to just point out certain aspects like this.
Large cap retail. We in the studios here are guessing whether that was trend that you were hinting at.
Look, there are only two of them, Trent and DMart. As a house, we've got to buy on both.
Okay, all right, awesome, Venu.
Data, so I can share that.
That's helpful. Thank you very much. Always great speaking with you and getting all that perspective. Always a good conversation. Thank you so much for joining in. Just a quick peek back at the market, which kind of is stabilized. I mean, at least the fall hasn't gotten wider or deeper. 23,380 thereabouts is what we're looking at. That's about a little over